Thanks so much for tuning into this earnings call with the management of Mphasis. The Q2 revenue growth of 3.18% sequentially at about 3,520 odd crores. It's versus an expectation of 4 odd percent on the revenue growth side. There, the company's come in slightly lower than what the Bloomberg estimates were, but on the bottom line front, is exactly in line. Margins have remained steady. Let's get in Nitin Rakesh to talk about how he thought the quarter went by and the half year went by, and what does the slightly iffy macro around the world suggest to him in terms of how Indian IT and Mphasis could perform. Nitin, great having you. Thanks for joining in. Good evening to you. How did the quarter shape up? Because compared to your own past performances and compared to the Bloomberg estimate, there is a small let up on the revenue front from Mphasis this time.
Yeah, I think, Neeraj, firstly, thanks for having me. I think it's been a fairly uncertain environment. And I think the worst thing for businesses is uncertainty, right? We don't know whether we are heading into one or we are already in a recession. That also creates some pressures on the overall, I would say, mood and sentiment. But more importantly, I think specifically around Q2 23, I think there were some puts and takes. We are very pleased with the fact that our core business performance is very, very strong. Applications growth 34% year over year. All client categories have actually grown. Top 10, top 20, top 5, next 5. Every category has grown. New client business has grown 53% year over year. I think there were two really specific pockets of weakness that, in a way, blunted some of that growth that came out of these core sectors. Obviously, well-known fact that the mortgage market in the US is undergoing a severe stress, cyclical downturn. We have a pretty strong business there that was a very good growth driver for us for many years, and I think that business saw some unexpected ramp downs given the change in the pace of interest rate tightening. So that definitely was a little bit of I would say, unexpected surprise within the quarter. Second, there were also some client-specific weaknesses that spotted up and leading to certain client-specific actions, either resulting in an unexpected furlough or certain slowdowns in spend patterns. But I think keeping all of that in mind, the banking business still grew very well. All verticals grew healthy double digits for the year. So for the quarter YOY basis, I think it's a little bit of a mixed bag. But having said that, our core strategy of driving growth through in-account proactive motions, leading clients, helping them transform their estates, taking cost out of their operations, and of course, the wallet share gain motion, all of them seem to be working well.
So, well, despite these uncertainties, and I have a question on that as well, but despite that, I mean, the release shows that the deal wins look steady at about over $300 million TCV. You would have been pleased with that.
Very pleased with that. I think what I'm even more pleased with, and we'll talk a little bit more about it shortly, is the fact that our pipeline is actually up 18% quarter over quarter, despite the 300 plus million of deal wins in quarter. What that shows you is exactly what I was talking about, which is the fact that in-account proactive motion, helping clients transform their estate faster, taking cost out, all of that seems to be working very well. So I think while there is a slowdown in the general environment, especially from a sentiment standpoint, uncertainty driving some of those decision-making delays. But at the same time, I think our ability to close deals is still pretty robust, and our ability to originate deals at a faster clip is something that I'm very, very pleased by.
Yeah, and the larger deal wins too. So Nitin, fill this in over the next 2 quarters, if indeed one of the principal drivers, which is mortgage, remains under stress, because we don't know how this will shape up. At the same time, you are having a strong pipeline and the ability to close large deals as well. How do you reckon? What's the best guesstimate, if you will? And maybe if that is not the right term, then excuse me. But what's the best guesstimate that you have, or how does this part of the picture shape up?
Yeah, let me just deconstruct, I think, what we are going through right now a little bit more. Right? If you look at even the mortgage business, which actually was a very strong driver of growth for us over the last 2.5, 3 years. The reason why it was a strong driver of growth was in the previous downturn, when we had an interest rate tightening cycle in 18 and 19, we actually used that opportunity to consolidate our position with our customers. We also used the opportunity to take out competitors. And more importantly, we diversified that service line and added new lines within the mortgage business, right? So we were primarily origination driven. We added home equity loans, we added diligence services, and we added some elements of mortgage servicing. We are probably taking a very similar stance today, where we are looking for opportunities to use this to really strengthen our position even more. We already have seen the positive impact of diversification, potentially, not to the extent that we would have liked to, because the pace of change has been very, very rapid. But I think what we're continuing to do is taking a growth-oriented mindset in that business even today, because we do believe it is a very core part of the US banking system, and we will continue to drive opportunity and growth. If you then look at the question you asked me, which is how do you really look, how do you think the rest of the year will pan out? I think on the core business, we definitely think the rest of the year will accelerate. The growth will continue to accelerate to the rest of the year. Yes, Q3 is a seasonally weak quarter, given the holiday impact and some impact on furloughs. But given the deal momentum we saw in Q2, given the headcount metrics, we actually added a very healthy number of billable headcount in quarter in Q2. I think the run rate operating momentum will carry us through the second half of the year, especially given just the fact that we are so focused on closing large deals as well. So I think we do expect second half of the year to continue to improve as we see some impact of the mortgage slowdown behind us, but it's very hard to pinpoint when that impact will actually be fully behind us, because we did get a little bit of a surprise in Q2 from that front.
So despite the drag in DXC as well as the mortgage, you expect the second half to be stable at the very least, so to say.
Yes.
Okay.
And I think from a deal win standpoint, from a pipeline standpoint, it actually might even be better. But again, hopefully the environment will not get way too harsh. But having said that, driving deals, driving discussions, driving wallet share gains, we have a very, very robust in-account playbook right now that has been unleashed by every account leader, because we just think crisis and opportunity kind of go hand in hand. So that's the stance we are taking.
Nitin, the markets are slaves to earnings, and I think in companies like yours or the one or two other who like you have been winning deal wins consistently, I think it's that deal win and the order booking which has held them in good stead through what was arguably a period of uncertainty for a lot of IT firms. So my question to you is therefore that would you reckon that should be the cornerstone of how you, or that could be the cornerstone of how you would believe business is doing, the deal wins coming in, the order pipeline, and thereby the execution, which will largely be in your hands?
To a large extent, yes. I'll just add two more metrics to it. One metric is, end of the day, we are a reflection of enterprise tech spend. We did very recently, we actually did a very intensive survey with our enterprise customers, on an anonymous basis, so there was no bias in it. About 2/3 of them believe that they will continue to spend in transforming their estate through the remainder of this year and next year. However, they will relentlessly and next year, but they will relentlessly prioritize how to shift the spend within their budget. So if you're aligned on the right side of the trend, you will definitely see an uplift in share gains and availability to win deals. Second data point that I think we should continue to focus on is the growth driven by one segment, one customer, one geography, one vertical. I think in our case, given that 80+% of our revenue is US, that's obviously the core market, and that is growing very strong for us. But the growth is actually very broad-based within that market as well, right? So I think that those three things really are the cornerstones of where we think we want to continue to invest. We've seen the gains play out over the last 3-4 years, and we do believe that the entire strategy that we played out within account focus, high touch, high trust, high tech mindset will definitely hold good stead through the uncertainty.
So, well, okay, which is heartening to know if clients are saying that they would actually continue to spend until 2023, but might just reprioritize how they do it. That's great to know. Nitin, so therefore, would you reckon that the headcount addition versus the attrition issues, based on the kind of order wins that you're doing, would help you, one, in execution per se, and two, in what everybody's trying to do, which is this whole pyramid rationalization and what levers it could add to margins? Now, in your case, you maintain margins all through the COVID period of 2 years, right? Because you reinvested in capabilities or what have you. It was not a bump up and then maybe a cool off that maybe a couple of other peers would have seen. Would you reckon that trajectory could continue for you with all of the measures that you take?
Yeah, I think the big unknown in that whole hypothesis at this point is, will the talent market actually ease up? It shows some green shoots, but it really, there hasn't been a meaningful easing in that model. And I think while there is some tailwind from currency to kind of take that back into your margin, There is also obviously continuing tightness especially in the right skills in the right program. So I think if that eases up, and we've seen some signs of that, especially in the last, towards the end of the quarter. We saw some signs early in the summer, but it really isn't meaningful yet. So what we have to really do is to contend with continued tightness and use all the other levers to make sure that our growth continues to be profitable with the stability in the margins as we forecasted. And we will use whatever levers we have to dial up and dial down in quarter investments, because most of our investments are OPEX in nature. And that's what you saw this quarter as well, that we were able to maintain the margin line while, we've continued to obviously invest with clients, invest in capabilities, invest in winning deals.
Actually, the street is of the belief, and I read 2 or 3 reports that an improving revenue mix, maybe optimization and utilization could actually enable you to improve from where you are right now. Is that too optimistic in a scenario like this?
Not really, because I think we consciously dropped our utilization because we were also undergoing certain headcount pyramid actions. We onboarded a fairly large number of fresh grads last year. We've seen that at least on a period end basis, maybe not on a reported average basis, but on a period end basis, our utilization actually has gone up by 4%. We think that's a trend that is likely to continue, because we are right now prioritizing revenue growth and margin stability over really building a very large bench, because we do believe that we'll have the opportunity to take advantage of the market conditions that might actually be more favorable from a supply side over the next 6 months.
Well, okay. So I hope that the good things continue and the slightly iffy things ebb very, very quickly. Nitin, to you and your team, firstly, thank you so much for speaking to us today, and a very happy Diwali and a prosperous New Year.
Thank you, and happy Diwali to all of you as well.
Yeah.